Welcome back to JPX Energy Market Weekly Updates. Crude oil benchmark prices bounced back on the back end of last week on expectations of further cuts to Russian supplies next month, but failed to gain upward momentum at the start of the week as market sentiment remained fragile. Further rate hike prospect and a sharper than expected jump in U.S. inventories added to demand concerns. This week, oil prices are still likely to be dominated by economic data. Signs of recovery are coming from China, with consumption on the rise. However, industrial activity is now rebounding in step with consumption. Analysts and traders will be now watching the next China PMI release due out on Wednesday. On the micro side, bearish had been viewed as a series of U.S. economic data suggests that higher inflation may last longer than expected, putting the Fed in a position where it likely will continue to raise interest rates, which in turn will likely pressure firm earnings. The headline flash U.S. market PMI composite output index registered 50.2, up sharply from 46.8 in January. The most marked change in performance was recorded in the service sector. However, it should be noted that U.S. manufacturing downturn remains solid. Whereas manufacturing input cost inflation eased in February due to improving supply chains, average selling prices for goods leaving the factory gate rose at a faster rate for a second successive month, in part because firms reported the need to pass through upward pressure on wages. Friday's strong inflation data continued the week's spate of market-unfriendly news. The Federal Reserve preferred measure inflation, known as the PCE, ticked higher in January. Much of the surge came from the 2% rise in energy prices. However, the core PCE index, excluding food and energy, also increased 0.6 for the month and was up 4.7% from a year ago. Tighter monetary policy has yet to fully impact consumers and shows the Fed has more work to do in slowing down aggregate demand. The Fed minutes were also a bit hawkish, as a majority of Fed officials agree the risk of high inflation remain a key factor shaping monetary policy and warranted continued rate hikes until it was controlled. Change in sentiment followed Reuters' report that said Russia will be cutting the volumes of oil exports by its western ports in March and April by as much as 25%, which would significantly exceed the announced total cut of 5% on overall oil supply. As the war continues to pressure Russia's finances, further increases to the tax burden on Russian producers are possible, threatening upstream investments. Combined with the impact of sanctions and price discounts, this could prove critical to Russian oil production volumes going forward. On the western side of the Atlantic Basin, U.S. crude oil inventories climbed for the 9th straight week and were at the highest level since May 2021. Inventories grew due to another fall in refinery utilization despite a rebound in exports. U.S. refinery runs typically reach their annual high point in mid to late August. Because all refining margins hit all-time highs last year, refineries ramp up operating rates and postpone their seasonal maintenance plan. Even with the refineries going into maintenance, refining margins fail to get any uplift, which is another sign that the global product overhang remains for now. Okay, that's all we have for this week. Welcome back next week.